So for the past 12 months, I've been casually looking to buy a property for a new land hack project and to expand my portfolio. The previous year, I had already traveled to Texas twice and Utah once, scoping out areas on land. But what I've been seeing, especially in the past few months, is what I'll call a money grab in the housing market. I'm literally seeing 50 to 100% increases in prices from a year ago as people are trying to cash in on their properties. This is similar to you having to pay $15 for a foot long at Subway. I'm sure you millennials can relate to all of that. All this made me reconsider my strategies when it came to purchasing property and land hacking, and I found one that not only gives me plenty of purchasing power when I'm ready, but still gives me the ability to access properties and work on my next deal even when the market is red hot. However, the economics from the greed in the housing market is becoming very apparent, and for those of us with the knowledge can prepare and take advantage of it. So starting off in spring 2020, we saw a steep decline in the supply of homes in the real estate market as the economy shriveled up and people were hunkering down, which can be seen here with this crazy drop. But as medical science was advancing, the nation becoming flush with trillions of dollars of extra dollars, and the Fed dropped interest rates, what the government was trying to do actually worked. They artificially staved off a massive recession and created record highs in the stock market and now the real estate market. Remember, the real estate market always tends to lag the stock market by a little bit. But yay! High stocks and high real estate! Hashtag winning, hashtag Tiger's blood. Right, guys? No? Okay. But any half-wit business student can see this is not sustainable. Propping up an economy with freshly printed money, low interest rates, and anti-foreclosure and eviction laws are temporary, painfully short-lived solutions. The real question is, when will this house of cards come crashing down, or in the absolute least slow the down? So it's not a massive bidding war with 18 other people every single time you want to buy a piece of property. So going in Kai research mode, I poured over graphs, economic journals, hours of YouTube videos, and researched the markets that I knew well, and I figured it out. Okay, maybe I didn't solve it per se, but I did learn that there are 4 key things to keep in mind as this fire in the housing market rages and how it will eventually burn itself out. First, monthly housing supply is at pre-illness levels. Monthly housing supply is basically the ratio of house for sale to houses that have sold. And what this ratio tells us is the size of the current housing inventory, but more importantly, how long would that inventory last if no new houses were built? So you see here the monthly supply has increased very drastically, and as supply increases, that relieves the pressure from pricing. And then obviously the opposite is true. When supply is low, pricing is higher. Okay, but enough of the statistics mumbo jumbo. What does this really mean for us? It means as more and more people are trying to get into the cash grab and asking ridiculous prices, that there will be a larger supply of homes sitting on the market that buyers will not buy, because they just can't afford it. So as long as people keep putting their homes up for sale and asking for these insane prices, the inventory in the market will continue to grow until prices will break and come back down to normal. Secondly, building off of that, housing prices growth at this rate is not sustainable. Stocks in real estate can only grow so much so fast before a correction, or worse, a crash happens. The average real estate appreciation in the United States is between 3 to 6%, depending on your specific market. And just in 2021 alone, we're seeing increases of median home prices from 10% to 30% plus. I've personally seen even as high as 100% in some isolated cases. This type of growth is unsustainable for buyers to continually afford to purchase these homes, and also because of this next reason, number 3, a giant backlog of new construction, evictions, and foreclosures are coming. Do you remember a couple months ago that confusing ship with the name Evergreen painted on the side of it, yet somehow being called the Evergiven blocked the Suez Canal? Well, that didn't help pricing or availability of a lot of stuff that we all frantically buy on Amazon. But while the Evergiven, or Evergreen, blocked the canal, masses of other ships were piling up on either end of the canal waiting to pass through. And each day, that number of ships grew, and so did the pressure increase. That's the same thing that's happening now in the housing market. Manufacturers had originally reduced their forecasts expecting the worst from 2020. construction companies did the same exact thing. But what happened? Demand shot up because of low interest rates and high access to money. So manufacturers and construction crews are now working around the clock to pump out products, supplies, and homes for this massive demand. A balloon demand. And trust me, there's a lot of building happening right now. Then on the other side of the coin, the government prevented evictions and foreclosures, which is still in effect today. But those laws will be expiring soon, and there will be a massive backlog of homes that will enter foreclosure and tenants getting evicted. And if modern day society is good at anything, it is swinging the pendulum from one end to the next. So right now, as supplied housing seems to be limited, I see the pendulum moving significantly when everything is opened back up, and these construction companies will be flooding the market with new homes once supply from the manufacturers catch back up. And with all that money in the economies today, they will not only catch up, but they most likely will overproduce, and the cycle will repeat. Number 4 is slowly climbing interest rates. Those sneaky little guys and gals over at the Federal Reserve have been doing something called QE, or quantitative easing, which is depressing the federal interest rate ever since the whole 2020 fiasco began. However, we can see that rates are slowly going up as economies begin to recover. The higher this rate climbs, and depending on the speed, it will send housing prices down. And guess what? This can't be depressed at this rate forever. It's a sweet dream to have interest rates lower than inflation rates, investors' paradise. Alas, it will be going back up. It's just a matter of when. Just like how it grew tenfold between 2015 and 2017. And if any of you were buying a home after 2017 to 2019, you may have noticed that interest rates were about 5% and inching towards 6%. So all this seems to be out of our control, and we're at the whim of the market. But it is. It actually is. I'm sorry. I do have an ace up my sleeve. For you. We can tap into the pulse of the market and watch what's happening with real numbers and data with websites that give us accurate economic data like Fred. Totally not sponsored, but I use them all the time for research and when I need data. It's a credible source, and it has a strong reputation amongst journalists, academics, and even economic professionals. And in our case, I'd say keep an eye on the federal interest rate and housing supply. I got both links just down below. Feel free to bookmark them and once a month pop them up and see what's going on. Seriously, not a sponsor, just really helpful data. Now, I had mentioned with everything going on in this fire hot market, I had to shift strategies a bit because no matter what, I refuse to pay $700 a square foot for a dated single wide home. But what I'm doing is, even if I can't find a deal that makes sense, I can still leverage high valuations of real estate with HELOCs and cash out refinances to gain access to my equity. Now, you're probably asking,
Kai, why do you want to pull out money if you don't have a deal right now or in the foreseeable future?
Great question. Because my interest rates on it is 3%. And when you factor in the tax incentives and leaving the money in just a high yield savings account is at around 0.5%, that brings my effective loan interest rate down to less than 2%. Having access to several hundreds of thousands, if not millions of dollars at 2% is essentially free money when you take into account inflation. And I like free money. Now, there's a careful balance between a large enough HELOC and taking cash out. I don't want to just be sitting on a pile of cash as we step into the unknown of potential high inflation, or a period of high inflation. So now that I have a bunch of liquidity, how am I going to be getting deals? Simple. Lease and hack, or wait for the market to cool down and the deals expose themselves. You can still create projects that cash flow, but don't necessarily need you to own the land. Regardless of the economy, you should always be looking and ready for opportunities. You can watch my video right here on the 267 acres we're getting for $0 out of pocket. So when will we see this correction or potential crash? I'm not entirely sure. The backlog of construction, foreclosures, and evictions will be coming up very soon. I'm currently wrapped up in one as we speak, and there will be a wave of oversupply when it comes to homes and materials in the upcoming year and years. But one thing is for certain, the market is cooling off as we head into the fall and winter seasons and the world begins to rebound to pre-2020 routines. Now, I highly doubt a crash like 2008 will occur, but prices will have to come down from these insane $400 to $500 plus per square foot valuations for below average homes built in the 1970s. The other control lever in the market is that banks will not even loan on homes with these types of valuations. That also helps the runaway inflation of housing prices in this market. So how can you take advantage of it? Create a similar strategy where you have high liquidity, but still hold on to your cash flowing assets. But if you're not able to do that yet, and you feel like you have to sit on the sidelines for a bit, don't count yourself out of the game just yet. Just because you're on the sidelines doesn't mean you can't do anything. Focus on your financial markers: steady income, credit score, debt, cash reserves. But just as importantly, expand your knowledge and understand how to look and close on deals. Now, I talk all about it in this video, so go check it out and see how I'm negotiating 267 acres with no cash out of pocket. I love you all, and I'll see you guys in the next video. Kai out.